The issue of how the rich avoid paying taxes is a controversial and complex one, with a variety of methods being used to minimize or eliminate tax liabilities. In this article, we will explore some of the most common ways in which the wealthy avoid paying taxes. 1. Tax havens. One of the most popular methods for the rich to avoid paying taxes is to establish offshore accounts in tax havens, such as the Cayman Islands, Bermuda, or Switzerland. These tax havens offer low or no taxes on investment income, as well as confidentiality and privacy for account holders. By keeping their money in offshore accounts, the wealthy can avoid paying taxes on their investment earnings, which can add up to substantial savings over time. 2. Trusts. Trusts are another popular method used by the wealthy to minimize tax liabilities. Trusts are legal entities that allow individuals to transfer assets out of their own name and into a separate entity. By doing so, the individual can avoid paying taxes on the assets transferred to the trust. Trusts can be used for a variety of purposes, including estate planning, asset protection, and tax minimization. 3. Charitable giving. Charitable giving is a common strategy used by the wealthy to reduce their tax liability. By making donations to charitable organizations, the wealthy can claim tax deductions on their income taxes. This strategy is particularly effective for those who donate appreciated assets, such as stocks or real estate, as they can claim a deduction for the full market value of the asset, rather than just the amount they paid for it. 4. Offsetting losses. Another way the wealthy avoid paying taxes is by offsetting losses against their income. For example, if a wealthy individual experiences a loss on an investment, they can offset that loss against their income for tax purposes. This strategy is particularly effective for those who have a high income, as they can use their losses to reduce their tax liability in the current year or carry them forward to future years. 5. Tax shelters. Tax shelters are investment vehicles that offer tax benefits to investors. These vehicles are often marketed to the wealthy as a way to reduce their tax liability, while also providing a return on their investment. Tax shelters can take many forms, including limited partnerships, real estate investments, and oil and gas investments. By investing in these types of vehicles, the wealthy can claim tax deductions on their income taxes, which can reduce their overall tax liability. 6. Capital gains. Capital gains are profits that are earned from the sale of assets, such as stocks, real estate, or artwork. The wealthy can avoid paying taxes on their capital gains by holding onto their assets for a long period of time. By doing so, they can take advantage of lower long-term capital gains tax rates, which are generally lower than short-term capital gains tax rates. Additionally, the wealthy can avoid paying taxes on their capital gains by donating appreciated assets to charitable organizations. 7. Tax credits. Tax credits are another way that the wealthy can reduce their tax liability. Tax credits are dollar-for-dollar reductions in the amount of taxes owed. The wealthy can claim tax credits for a variety of activities, including investing in renewable energy, purchasing electric vehicles, and investing in low-income housing. By taking advantage of these tax credits, the wealthy can reduce their tax liability and save money on their income taxes. In conclusion, the issue of how the rich avoid paying taxes is a complex and controversial one. By establishing offshore accounts in tax havens, using trusts, engaging in charitable giving, offsetting losses, investing in tax shelters, taking advantage of capital gains, and claiming tax credits, the wealthy can significantly reduce their tax liability. While these strategies may be legal, they raise questions about fairness and equity in the tax system, and many people argue that the wealthy should pay